Hey everybody, welcome back again to our channel, your go-to hub for mastering the world of finance and fintech, and empower you to make smarter money moves in the digital age. Let's dive into how to analyze a stock as beginners. Analyzing a stock might seem overwhelming at first, but with a basic understanding of key principles, you can start making informed decisions about your investments. Here's a step-by-step guide to help you evaluate a stock's potential. Step 1. Understand the business. Before diving into numbers, it's crucial to understand the business behind the stock. Ask yourself, what does the company do? Is it a technology company, a retailer, a healthcare provider, etc.? Is the company a leader in its industry? Research its market position compared to competitors. What are its products and services? Consider whether these products are in demand and if the company has a competitive advantage, brand recognition, technology, or a unique business model. Who are the company's customers? A diverse customer base can be more stable than relying on a small group of customers. Step 2. Check the company's financial health. The financial health of a company is one of the most important factors to analyze before buying its stock. You can get this information from the company's financial statements, income statement, balance sheet, and cash flow statement. Key factors to focus on include earnings per share, EPS. EPS is a measure of a company's profitability and tells you how much profit the company makes for each share of stock. A rising EPS over time is usually a good sign of profitability. Formula: EPS equals net income / shares outstanding. Revenue and revenue growth. Revenue is the total amount of money a company makes from its business activities. Look at how the company's revenue has grown or shrunk over the past few years. Consistent growth is a good sign, but you also want to understand the reasons for the growth, new products, market expansion. Price to earnings ratio, P/E ratio. The P/E ratio compares a company's stock price to its earnings. It's a popular metric for evaluating whether a stock is overvalued or undervalued. Formula: P/E ratio equals stock price / earnings per share, EPS. A high P/E could mean that investors are willing to pay more for each dollar of earnings, indicating high growth expectations. A low P/E might suggest the stock is undervalued or that the company's earnings are struggling. Debt levels, debt to equity ratio. A company's debt level is critical because high levels of debt can make it riskier, especially if the company has trouble paying off its liabilities. Formula: debt to equity ratio equals total debt / total equity. A low debt to equity ratio generally indicates the company is less reliant on debt, while a high ratio could mean it's more vulnerable in times of economic downturns. Profit margins. Profit margins show how efficiently a company turns revenue into profit. A higher profit margin suggests that the company is managing costs well. Formula: profit margin equals net income / revenue. Look at gross margin, operating margin, and net margin to assess different stages of profitability. Step 3. Evaluate the company's growth potential. When analyzing a stock, it's important to consider the company's future growth prospects. A strong track record of growth might be indicative of a promising future, but also look at industry growth. Is the industry growing? If the company operates in a growing industry, it might have more room to expand. Market share. Does the company have a growing market share within its industry? A company gaining market share is often in a strong position. Innovation. Is the company investing in new technologies or expanding into new markets? Management team. A company's leadership is key to its success. Research the CEO and key executives. Have they been successful in the past? Are they experienced? Step 4. Consider valuation and stock price. While a company might be performing well, its stock might not be a good buy if the price is too high. To gauge whether a stock is fairly priced, use valuation metrics. Price to earnings, P/E ratio. As mentioned, this metric compares a company's stock price to its earnings. However, it's important to compare a company's P/E ratio to its industry average and historical P/E ratios. If a company's P/E ratio is higher than its peers, it might be overvalued, but it could also mean that the market has high growth expectations. Price to book, P/B ratio. The P/B ratio compares a company's market value to its book value, net assets. It helps determine whether a stock is undervalued or overpriced relative to its assets. Formula: P/B ratio equals market price per share / book value per share. A P/B ratio below 1 might indicate the stock is undervalued. Dividend yield. For income-focused investors, the dividend yield is important. This measures how much income you earn in dividends relative to the stock price. A higher yield can be attractive, but be cautious if the yield is unusually high. It may signal financial instability. Formula: dividend yield equals annual dividend per share / stock price per share. Step 5. Look at the stock's historical performance. Past performance isn't always indicative of future results, but it's still useful to look at a stock's historical performance over different time frames: 1 year, 5 years, 10 years. Consider how the stock performed in both good and bad market conditions, and whether it has shown resilience during economic downturns. Volatility. How much has the stock price fluctuated? A stock with high volatility may offer greater potential rewards, but comes with higher risk. Consistency. Has the stock shown steady growth over the long term? Step 6. Monitor market conditions and news. Stock prices are influenced not only by the company's performance, but also by market conditions and external factors such as economic trends, inflation, unemployment rates, and economic growth can affect stock prices. Interest rates. When interest rates rise, borrowing becomes more expensive and stock prices can fall. Geopolitical events, global crises, trade wars, and political uncertainty can impact stock performance. Industry-specific news, regulatory changes, innovations, or scandals within the company's industry can dramatically affect stock prices. Step 7. Make your decision. After performing all the above steps, you can decide whether the stock is a good investment for your portfolio. Ask yourself, does the company have strong fundamentals, solid earnings, growth potential, low debt? Is the stock fairly valued based on metrics like P/E and P/B ratios? Does the company operate in a growing industry with good management? In conclusion, stock analysis might feel complex, but by breaking it down into digestible steps, you can start making informed investment decisions. Focus on understanding the company, its financial health, and its growth potential, while considering market conditions and valuation metrics. Always keep in mind that investing in stocks carries risk, so it's important to diversify your investments and make decisions aligned with your long-term financial goals. If you found this video helpful, don't forget to like, subscribe, and click the bell icon for more finance tips. And if you have any questions about how to analyze a stock, drop them in the comments below. Thanks for watching, and I'll see you in the next video.